Okay, a lot to cover here ahead of Seafair weekend with a surprise downgrade of the U.S. credit rating here this week. We will break down earnings, although we'll spend a little less time on that than planned given the news. And then a great question of the week, basically, is AI the next dot-com bubble? I am very excited to kind of share some thoughts around that because we are hearing about it nonstop, even more so than last earnings season. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, trends we're watching, and hopefully weed out a bit of the noise along the way. Here we are on Thursday. If you are in the Pacific Northwest, it is Seafair weekend. So hopefully you are able to get outside and enjoy the sunshine. I get to that. I want to just back up a little bit and touch on some things from last week. So first thing I want to touch on is PCE data. Even though this news is important and earnings are important, let's not forget inflation is also very much so in the in the focus here. So PCE data on Friday did show a slight tick down in core. That's what I'm really going to start focusing on here moving forward. Core PCE year over year. So the PCE index for the month was basically right in line with expectations, but again, it did bring down core PCE slightly year over year. This week on Tuesday, we also had job openings at about 9.58 million. So very slight tick down from last month, but we've seen a lot of news around some, very, let's call it like economic growth type of data points here this week. So all this is very interesting. Again, core PCE did tick down slightly, but still far above the 2%. Yet here we are with a giant jobs number on Wednesday. That's really part of what I'm referring to. ADP employment report showed we had 324,000 jobs for the month. So between all this data, the question, of course, is like, okay, so if inflation is cooling, but the Fed just last week said that they suggested that they saw signs of the economy cooling, yet jobs data is certainly not showing that. What the heck are they going to do? And let me just maybe share, I don't want to get too far in the weeds quite yet because tomorrow's data point, the non-farm payrolls number, is the one to really pay attention to. Initial jobless claims came out today, still low, nothing to really report there. And especially since I want to maybe spend most of our time on the two big stories and then our question. The first is just yesterday, Wednesday, the U.S. debt or the credit rating Fitch downgraded our U.S. credit rating. Now it went from the best to one step below the best. So bear with me a little bit. It's not. It doesn't mean that we're like considered some sort of like junk bond or high yield, high risk type of credit agency at this point or credit organization, but it certainly is a big deal. This is something that came as a result, they said, of the back and forth on the debt ceiling being risen. So, I think that the more that these conversations come up, it's clear that maybe the rating agencies are starting to take this a little bit more seriously and maybe kind of put their foot down a little bit more that, maybe this is not something that can continue forever. Nonetheless, we did see a market pullback, as you might imagine, yesterday. That said, it was not nearly what I might have suspected, to be honest with you. A debt downgrade, I think, is pretty important. It's big news, and really we saw markets down. But I think last time this was in the conversation, markets were down almost like 4 times what they dropped yesterday. So certainly a down day today, is looking that way as well. But not nearly maybe what the reaction could have or might have been in previous conversations about this. As far as earnings breakdown goes, what I wanted to spend some time here on before I actually share where we're at in terms of kind of progress and scoreboard is to really talk for a minute about the difference between actual earnings and earnings expectations. All right. So actual earnings are what the company is showing, year over year, quarter over quarter, where their earnings either is growing or declining or in between, right? There's earnings and revenues that are typically looked at, in the most scrutiny, right? Those are two of the biggest numbers that we pay attention to. And it's really important to know that earnings could be up or down from the year prior, and expectations line up with that, with where they expect that to go. Expectations on the other side, right, is exactly that. So earnings can be coming down analysts may expect earnings to come down, so they may share their expectations are lower, but a company might still beat on those expectations. So an analyst might say, we expect earnings to decrease by 7%. And the company comes out and says, well, earnings only decreased by 6.8%. Technically, that is a beat on earnings. But the question is that a good sign of earnings? And I think that's really important to put in perspective, because what we're seeing this quarter is really starting to show that, right? I think just shy of about 70% of companies that have reported so far have beat their earnings expectations, all right? Expectations. Now, as of last Friday, I don't have this up-to-date data quite yet. I'll get it again tomorrow. But as of last Friday, what's important to note, so that's expectations. Earnings have actually declined so far over about 7% in terms of total earnings in the companies. So keep this in mind, right? You hear news about earnings expectations being beat does not mean earnings are growing. They're two totally separate things. If earnings kind of continue like this, it's another big quarterly drop in earnings, one of the largest since we've seen since 2020. So it kind of puts things in perspective a little bit. Now, generally, markets price on expectations. So if the expectation is lower than what we're actually experiencing, that still is a good thing, because maybe markets are starting to say, okay, well, maybe these companies are going to be either more profitable or maybe soon. So hopefully that's helpful. That's kind of a quick view of the scoreboard so far. Next week, we will break down the non-farm payrolls coming out on Friday. We have CPI data. So again, inflation is in the headlines, CPI and PPI next week as well. So we'll break that down. We have a great question of the week, which is AI the next dot-com bubble? And if so, like, what can investors do to kind of protect themselves against this? This is, I think, huge. We touched on AI last earnings season as well, as it seemed like every company had to say those words in their earnings call, or they were punished for it, basically. Now, I think that in terms of the actual question itself, is this a dot-com bubble? I don't know that I would say that AI is the next dot-com bubble, but I would suggest that if you look at certain pockets of this, there are a lot of similarities that can be kind of taken away. It is clear AI technology is very helpful, just like it's clear blockchain technology is very helpful and has a role, right? But this does not mean because a company is first or early on in this trend, or just happens to be in the space, that they're going to be successful, right? Just like the dot-com bubble, internet is still here. It's very much a very real technology, but it doesn't mean, pets.com and every single company in that space is going to do well. So just like the dot-com era, this technology will have huge benefits. There's no question about it. But I think it is likely that maybe few actually rise to the top when all has kind of settled. Again, kind of similar to the NFTs as well. So just be cautious. I would suggest being cautious of buying everything and expecting it to rise. I don't think that's how really any new industry or trend really works. I want to talk about the companies utilizing AI, because I think that's a little bit of a different story as well. We're hearing about this, as you see, in all these earnings calls. So there's companies on the forefront of actually implementing or doing some of the research and bringing AI tools to the forefront. There's other companies that are using it to enhance efficiencies, profitability, you name it. Now, the reason I wanted to share that is because just because they mention that they're going to use AI in their business does not mean that all of a sudden they are more profitable and should be worth more. The benefits of these AI technologies to actually work their way through, especially giant companies' bottom lines, is going to take some time. So just because in an earnings call they mentioned we plan to use AI to increase profitability, my belief is that doesn't mean that the company should instantly be worth more, right? Which is what we're kind of seeing lately. And in fact, I think that obviously there will be long-term benefits to this as well. But in the future, if this is as big as it probably is going to be, if every company is using some form of AI, the question, I guess, is, will this actually even make them more profitable over a longer period of time, right? If all the competitors are using AI in some way, shape, or form, it may not actually mean that they're more profitable. It may mean that the money gets diverted elsewhere, right? It certainly will free up some efficiencies, but to be competitive, they may have to channel those funds elsewhere. So again, I wouldn't necessarily suggest it's the next dot-com bubble, but I do think that there are some similarities there and some cautionary tales to kind of take away. So I hope that is helpful. Enjoy Seafair weekend coming up. And we will see you next Thursday at 3 to talk a little bit more jobs and inflation.